Now, if we drill deeper into that analysis and we look at the factors that go into driving, and what that shows is that about 45% of the drivers, of the systematic drivers of Bitcoin are global liquidity factors. Okay. If you break down the remainder, something like 25% gold and about 25% what we call risk appetite factors. If you then look in detail at the gold connection, it's very interesting because what it shows is that Bitcoin and gold have a negative short-term correlation, but a very positive long-term correlation.
It sounds like you'll want to hold some crypto assets. You certainly want some Bitcoin in your portfolio. You may also want some gold as well. Like, what's your projection for those asset prices over the next, 5 to 10 years as this plays out?
Maybe two things. I mean, one is that if you look at it qualitatively in terms of a capital war and the two economies being, long-term rivals, then you're going to want to own both gold and you're going to want to own Bitcoin, because basically what we're getting against this background is persistent monetary inflation. Okay, so it's not Bitcoin or gold, it's Bitcoin and gold. I think that's definitely the case. And you might want to hold that in a portfolio, volatility adjusted. I mean, that may be a decent strategy. I think if you look at the scope for monetary inflation, I mean, the point here being is that you've got the likelihood that debt is going to grow at something like at least 8% per annum. And I'm using as a benchmark the sort of projections that the Congressional Budget Office, put forward for the US. And, the CBO is bipartisan, but it does project out, pretty transparently its data on debt and the fiscal deficit right out to 2050 and beyond. So we've got a good, amount of data projected here, and we can use that to try and extrapolate what it would mean for gold and Bitcoin. Now, since 2000 to 2025, you've had a 10 times increase in the stock of federal debt. I mean, that is a big number, right? The S&P has gone up by less than 5 times over that period, and gold prices have gone up 12 times. So gold has more than matched the increase in federal debt. Now, if you look at what the Congressional Budget Office is projecting for the debt GDP ratio, they're talking about 250% for public debt, federal debt to GDP. We're currently just over 100%. So they're going to double debt GDP. So in other words, debt is growing more than twice as fast as nominal GDP. So, that's the sort of metrics I'm saying, at least 8% growth here. Now, if you assume that gold prices continue with the same relationship to federal debt, in other words, that you keep the federal debt in real gold terms constant, then the gold price by the mid-2030s would be easily $10,000 an ounce, and by 2050, touching $25,000 an ounce. Now, if you then say, well, okay, what's the relationship between Bitcoin and gold, and what's the current ratio, about 25, 27 times, then do the math, and you've got, what that could mean.
That's fascinating. That's the point that you're making in many of the material that I'm reading about this move from Fed QE to Treasury QE. That's something that you're watching. And then the implications of that are, what assets does it make sense to hold in that world, in that environment?
Well, it makes sense to own things which are going to get more traction from the real economy. I think commodities should do well. I think US defense stocks are certainly worth thinking about. But the other thing to say is that, it doesn't detract from the longer term picture, which is that monetary inflation is here with us for the long term. And you've got to have Bitcoin and gold in your portfolio. And the best time to buy them is to buy them on weakness. And we may be seeing some upcoming weakness. A good time to pick up some more.